Let's bring everyone in on this. Talk about the markets and some warning signs. Our next guest says investors are ignoring. Richard Bernstein is here. He's CEO and Chief Investment Officer at Richard Bernstein Advisors and a CNBC contributor. Before we talk about warning signs,
yes.
How do you think that the average person would describe the economy and describe the stock market right now? I mean, is it... We know there are always imbalances, right? But do things feel dangerously imbalanced to you? Would you say we're in an economic boom? I mean, how would you characterize
Okay,
things right
it's
now?
not, first of all, to put in proper perspective, we're benchmark weight equities, so we're not amazingly bearish. But the reality is GDP growth the last 3 quarters has been below average. The yield curve is inverted. Corporate profits growth is 2%. And we're talking about things like Tesla and Virgin Galactica as being the future.
In terms of the real,
very strange.
And that's all
Battlestar Galactica. It's Virgin Galactic.
Oh, whatever it is.
Whatever. Okay.
You know, I mean, I don't think you're going to Mars anytime soon.
But here's my point, Rich. So you're absolutely right about the financial markets, but in the so-called real world, we also have in the unemployment rate at basically a historic low.
Absolutely.
Wages moving up. You know, so it's not just an artifice of financial engineering or something.
No. But I think as an investor, you have to sit here and say, what will people be talking about 12 months or 18 months from now? It's not what's going on right now. If you had said to people 2 years ago or 3 years ago that we would be in this situation today, people would have said you're crazy.
You mean with the unemployment rate?
With the unemployment rate, with the economy. Even if you did it 5 years ago, people would have said you were crazy. So I don't think today we should sit here and say, oh, wow, as investors, we could tell you, I'm not a politician, but we could sit here and say, is the economy great today? The economy's fine, yeah. But what are people going to be talking about a year and a half, 2 years ago, 3 years from now? And I don't think they're going to be talking about a ripping
You were bullish for a long time, and we gave you a lot of credit for that. Do you date your becoming less bullish 3 quarters ago?
Roughly. I'd say mid-year.
Where was the S&P then?
I don't even know where.
All right. Okay. So
if your point is the S&P.
No. I'm just saying. Let's say that it does. Let's say that eventually that there isn't a day of reckoning, and that we go on to 3,500 or wherever. Will you look back and say that I miscalculated something?
It wouldn't be that I miscalculated. It would be that a true arsenal of traditional indicators were all wrong. Okay. For instance, the yield curve. The yield curve is inverted. And everybody is now saying it doesn't matter, which is very typical in a late cycle.
At that point, what would you do, though? Would you still say? Do you ever say, okay, these signals that I saw were incorrect, and I need to now I'm going to go above benchmark weight?
I don't think for us right now. I think we'd have to be real proven wrong in the future. I think
that's what I mean. If we
significant
4,000, or if it keeps going up over the year,
it's not just the market though, Joe. Because I mean, we can go to 99 and 2000 and say the market kept going up and going up and going up, and then it crashed. And so from our perspective, it's the combination.
I mean, it's possible that it comes down, but it's also possible that it doesn't.
My point is that you want to have a fundamental backdrop to this acceleration in the market, and I think that's starting to diverge. I'm not saying that we have 99 right now.
I mean, there have been other analysts that have seen a problem with the fundamental backdrop for 5 years.
Yeah.
Guys from last year, Mike Wilson, who's the guy at UBS, Trahan. They had fundamental. They had problems for the last 40% of the market. They had a problem with the fundamentals.
But I think if you look at the traditional indicators that set up the warning signs one by one, if you 5 years ago, that was a stretch to say that there was really warning, but I think today it's a little more realistic.
Let me ask you something that last year seemed to change the narrative considerably, because early last year we also had the 3-month, 10-year inverted and a lot of warning signs. The Fed cut rates 3 times ultimately. Right now, Steve just told us they're pricing in better than 50-50 odds there's a rate cut coming this summer. Do you think a rate cut is coming? Why are we talking about one, again, with the unemployment rate where it is? And is that going to be the difference to once again kind of remedy the yield curve situation and unlock?
It's an interesting question, because remember, the Fed has a dual mandate, right? Low unemployment, stable prices. Why would they be why would they be in an easing mode with the unemployment rate of 3.6%? It must be the price side. They must be worried about deflation or turning it around. I think what people are missing is that the Fed has a sea change going on here where they're actually pro-inflation. This is not the Volcker Fed anymore. This is not a Fed that's fighting inflation. This is a Fed that wants inflation. And I think the amazing thing is that fixed income investors are fighting the Fed. And I think there is a major sea change going on here, both in monetary and in fiscal policy, by the way. That's very pro-inflation.
It's not that they see the sea change; they think it's not going to work. They're not going to get it.
Fight the Fed. right? I mean, that's what it used to be. It was that the Fed would ease and everybody would say, oh, it's never going to work.
Right.
They can't get the economy going.
But listen, and I'm not trying to make this too political, but you look at what happened in Japan. They passed that massive increase in the sales tax. The economy plunges 6% annualized. And here you have a situation where the pickup we talked about earlier under President Trump, it was pro-growth, it was tax reform, it was deregulatory, and now you have the campaign trail, the debate tonight, we're not going to be hearing that message. We're going to be hearing a message more like what just happened in Japan. And I'm just saying, if people want inflation, they want growth, I think those are two extremely different, outcomes.
Well, I think what happens is, politicians always talk about pro-growth. They never tell you if it's real growth or nominal growth, right? To a politician, they don't care. They want growth. And I think what's starting to happen and what we will see over the next several years is a shift towards nominal growth and away from real growth. And I think that's out there. I think that's the opportunity or the risk, depending on how you want to look at it, in the financial markets over the next several years.
Because it's just going to be spend, spend, spend?
Well, you've got consumer confidence at a high with the budget deficit growing. That has never happened before. So we've got this huge divergence going on between people's perception of what's going on and the reality of where that growth is coming from.
Yeah.
It's not really private sector growth right now.